afternoon. Welcome everybody to our webinar this month. You can see the topic, investment fundamentals do not change. But obviously we're in June, and June is Youth Month, and Youth Day was commemorated about 2 weeks ago, I think Friday the 16th of June. So yeah, I don't expect many call it young adults to be on this webinar. So parents or friends, I really appreciate it if you can maybe share the recording and the PDF of this presentation. I think it might help them. So the whole gist of this today's presentation is that we all know, and it's well established, that South Africa's young population is facing significant financial challenges that require long-term solutions. But saying that, and as obviously the topic says there, investment fundamentals for young investors have not changed today significantly. The basics of investing is still the same, and I have spoken about this in past webinars, things like setting financial goals and diversifying your investments, and obviously considering your risk tolerance. All those things still remain critical, but obviously there are a lot of new things happening. For example, we're getting call it a greater shift towards what we call value-based or ESG investing. So so I'll be touching on that a bit today. So the reason why I'm using this image of this lighthouse is just obviously to represent a storm. And I think that's where a lot of young investors might find themselves. They might find themselves in a financial storm, but as the lighthouse also represents hope. Okay, so you might have heard of the saying that the more things change, the more they stay the same. Some things change and some things still stay the same. These words obviously refer to things, situations, and people who stay the same and do not change. But also saying that there are things that change or that you may wish to stay the same, and there are things that stay the same and you may wish that would change. Saying that, obviously, I'm going to my agenda for today. Cool. There we go. So I think the very first thing there we can see, should investors take more risk? And there could be a lot of my presentation today is focusing on investment risk. So going back to that image of that lighthouse, the stormy sea, I just want to highlight something, call it negative. We all know that the biggest financial challenges facing young adults today is high unemployment rate. I saw that the quarterly employment stats came out, I think, about 2 days ago or earlier this week. It showed that not only were 97,000 jobs lost between March 2023 and March 2022, that's number one, but also total unemployment also fell by 21,000 jobs in the first quarter compared to the previous one. So yeah, that's number one. That's highlighting for a lot of these young adults nowadays: high unemployment rate, high levels of debt. I can talk that with my own daughter studying medicine, student loans. That's just very easy to get loans for these guys. It's been, just go to the bank and the banks will throw it at them, especially if they students and things like that. But I think the biggest challenge, and that's always why I have these webinars, is the lack of financial literacy. This is not taught in schools, and obviously financial literacy is important, especially for the young adults starting to work with money. So that is also a big challenge, is that lack of financial literacy. Obviously, there's other things like high cost of living and obviously limited access to financial products. But I think all these things do require long-term solutions. But it might sound like chaos, going back to my image now of the storm. But some of you might have read the book by Sun Tzu. He's the author of a book called Art of War, and obviously been it's a work that's very influential with call it a military strategy. But one of his quotes, and I want to bring it in here from Sun Tzu, is, "In the midst of chaos, there is also opportunity." And this is also a bottom line what I want to highlight for the young investors or young adults, is that, it might seem chaos and things like that. The idea is that things might not be going according to plan. When plans get disrupted, it's easy to make excuses and resign yourself to failure. It's much harder to adapt and persevere, or is it? So the whole idea is that we can just take a step back and slow down, and don't let anyone or anything drag you down. Take out the drama, or remove yourself from the drama, and then look for the positive. There's always opportunities. So who benefits from tough conditions like these? I always say, who becomes millionaires? It's people that take advantage of situations like this. People that focus their energy and attention on their own personal economy. These are the people that are industrious and dedicated and take control over the immediate environment. And that's the message I want to get through to the young guys today. So, my wish is for the young guys to create their own economy. Okay. So take full responsibility for creating your control for your economy, and obviously, don't let the effect of the financial environment created by the government and by others be effect on you. So, as I say, I have discussed this in previous webinars. How do you create that your own economy? Obviously, you want to control your savings. You want to spend less, save more, but also, start with investment. Things like emergency funds and things like that. But bottom line, is to have a economic plan or investment plan. I'll be touching that on today's webinar. Okay. So as I say, I have discussed it in previous webinars. It is on our YouTube channel. Okay. So, big question. Okay, should young investors take on more risk? So you might have heard of this thing called a risk aversion. What is risk? Being risk averse? It's someone that tends to avoid risk. And I see that a lot of times with young investors that are opening up accounts with us. They open up a unit trust account, a voluntary investment plan, and a young guy, he's just starting to invest, and he puts his money into a money market account. I don't know, obviously he wouldn't know exactly what his financial goals would be, but ideally, it's not for retirement, putting your money into money market, because that's long-term goals. If it's a short-term goal, yes, and he's creating an emergency fund, that's great. And obviously, having access to funds is also another criteria there. But the main thing is, if you're doing that, you're putting your money into a money market account because you want to avoid risk. That's the wrong way of looking at it. Yes, the main objective for a lot of people that are risk averse is to preserve their capital, and I understand that. But also you must understand that with investing, risk equals price volatility. So I want to be talking about taking calculated risks, and there's a process of doing that and things like that. So low risk means stability. Yes, I understand that also. But again, you want to be looking for growth, and I'll be touching on it in more detail in this presentation. So should young investors take more risk? There's pros and cons. Main thing I want to highlight is that time is on your side, and that's a big thing about being a young investor. Time is on your side, and obviously time on your side, and I've touched on this before, is you got to take advantage of compounding, the magic of compounding. So the idea is that yes, you're going to make mistakes, and the earlier you start, the better. You're going to make small mistakes because you haven't got a lot of money to invest. Okay, that leads to my third point there. So yes, you're not going to lose all your money. It depends what you're investing in, but the share never goes from to zero straight away overnight. Okay, unless it is a 5-cent share. But understand that your investment won't go to zero overnight. It'll go over a period of time, and you'll have time to take advantage of it, being aware of what's happening in your portfolio. So I believe that the biggest risk is not taking any risks. If that makes sense. Okay. So you want to be the person that makes fast or ill-informed choices. Obviously, will be making a lot of mistakes and will be losing money. But you want to be investing where, obviously the stock market has given you the historically the best growth. There's a lot of uncertainty there, but there's ways and means of bending the odds in your favor. Okay. But the best time to take these risks is early. That's my point here. So time is on your side. And then, the point here with risk means reward. It's worthwhile for young investors to take on risky investments. So have exposure to the share market. If you have a unit trust investment and you're starting out at 500 Rand a month, go buy an equity fund. Okay, there's a lot of equity funds to choose from, and there's ways and means of obviously of doing it also. But start with 500 Rand a month, start with an equity fund, because your goal is long term, and I'll be touching on it again just now. So, and that leads me to the third point there. Unless you're starting with a big sum of money, like an inheritance, or you won a lotto, or whatever the case might be, or other sources of funds. Young investors, obviously, they are a function of their limited capital. You earn a little salary and you want to maybe put 10% of your salary away. On our platform, you can start a little as 500 Rand. And obviously, over time, you might want to add more funds to it, and things like that. So the idea here is that if you're buying 500 Rand a month, and I'll be touching it on, that's the last point on lead to. If you're buying 500 Rand a month, at least what we call rand cost averaging. So, you're buying different cycles in the market. So at the bottom of the cycle, you're buying more units, and at the top of the cycle, you're buying less units. But over the long term, your cost is much lower. And that's also a big advantage. So it's the process of what I call phasing in. Compared to putting a lump sum, you might be buying in the top of the market by putting in a lump sum. So rand cost averaging is a big advantage for young investors. Start young. By starting young, starting early, starting with 500 Rand a month, take advantage of rand cost averaging, take advantage of compounding over the long term. This is how you build wealth. Okay. So obviously there are disadvantages too. The biggest disadvantage for a lot of young investors that these guys are cowboys. I remember myself. I believe that the guys are, you're driven and you're motivated, but you might have all the energy, what you call it, exuberance of youth, but you're not equipped. You haven't got all the knowledge yet on the market, and how the market functions and things like that. So educate yourself, and this is the whole idea about these webinars, is financial literacy. Educate yourself about the market, educate yourself about the products, the pros and cons, etc. Okay, and that's how you start learning to take calculated risk. By taking 500 Rand a month and putting it into an equity fund and learning all about that fund, this is how you start, slowly, baby steps. Okay, poor investment habits, and obviously a lot of I see a lot of times, especially people that are working for companies, they get a bonus now. A lot of companies are not paying out any bonuses, or they're keeping their staff there, and they give them share options or give them shares in the company. But that's all might be all the investment the client, the young investor might have. But you're putting all your eggs in one basket, so that's a big danger. So you might, you're taking on more risk by putting all your eggs in one basket. And you might, even though you might be taking higher risk, doesn't mean you're making higher returns. Okay, so that's a big challenge here for a lot of people. I see it with people, even with PSG, they get PSG Consult shares, and that's all they have. No other investments. I remember myself many years ago when I first started with PSG, I was giving PSG online shares that became PSG Consult stocks, but I sold half my stocks, and obviously I diversified, and that's how I started. Some of you might be saying, yeah, but everybody's doing the same thing. Everybody's chasing the hot stocks, and we'll be touching on it just now. The problem with the hot stocks, they might be at the top of the market. They're not cheap right now from a valuation point of view. They're overvalued. They might have very high PE ratios. And those are stocks that you do not want to be investing for long term. Okay, it might be the flavor of the month, but as Warren Buffett would say, be fearful when everyone else is greedy, and you must be greedy when everyone else is fearful. When everyone else is selling, you want to be buying. Okay. So the whole idea here also, young investors like to win big. They have that lotto mentality, or the roulette table. Let's put all our money on black and then hope. And I always say, hope is not a strategy. Okay. So the idea that is that reckless. You want to take, as I say again, calculated risk. There's a big difference between speculation and gambling. You want to, some people want to trade high risk shares. I'm talking about trading. There's a ways and means of being a speculator, but there's no use going for a high risk trade that's got low returns. To me, that's gambling. High risk, low returns, to me, that's gambling. Okay, so the whole idea here, again, just bottom line, is just keep learning and keep investing. Learn while you earn, as I would say. Okay, so the basics of investing. Let's talk about it very quickly. What is investing? Quite simply, it's you invest to create and preserve wealth. That is your main goal. So saving generally is putting your money in the banks and keeping it aside to ensure a relatively safe and obviously a fixed income. That's what you want from it. A low rate of interest. That's the danger there. Low rates of interest because it's low risk. Whereas you know, over the long term, you don't have all your money there for long term because of the impact of inflation. And going back to my investor I spoke about just now, storing the long term investment, putting your money into a money market account. No. Okay. So the idea with investing is obviously putting your money to work for you and provide a source of income or capital for the future. And that is what investing is all about. So you want to create both and obviously create capital growth and income, and obviously you also want to preserve your wealth. Okay, so most individuals obviously generate a profit or a return over the long term, especially the share market. And the share market is, for a lot of people, is where most of the money is having exposure to shares or free unit trust into equities because historically the higher growth. Okay, so what does a successful investment require? Two things. First of all, obviously planning and discipline. When I talk about planning, we've spoken about this before. This is all to do with your investment plan. In trading, we say plan the trade and then trade the plan. The whole idea there is to have your confidence, to eliminate a human emotion. Greed and fear are the biggest enemy. It's the same thing here. If you have an investment plan, you have a strategy, you take the emotions out of the investment side, and you're halfway there. So when it comes to planning, as I say, it's all to do with developing your investment plan. On the other side of the coin, discipline. This is where you start keeping market movements perspective. A lot of people have panic attacks when the market takes a bit of a knock. They sell and they move to the sidelines, and they don't get into again and wake up 5 years later and then bind on their goals. So, the whole idea is just to recognize potential impact of risk on the portfolio, and also to a large extent it's to do with rebalancing portfolio. We'll be talking about asset allocation and diversification just now. So it's important to define your investment goals, over different time periods, the short, medium term and long term goals and things like that. So, as a short-term goal, this is obviously the next 5 years. This is for young investors. You might need easy access to your funds. Obviously, your first goal is to set up a emergency fund, but also you might be setting up for a planning for that wedding that you want, or a new car or a new home. This is where the unit trust or a VIP account will come in handy. Medium-term goals, we're talking about for the next 5 to 10 years. This is where you plan maybe for your children's education or higher education. You might want to pay off a big lump sum on your home loan, pay off your bond. Longer-term goals, obviously, this is for the next 10 years plus, retirement, etc. Paying off your house or maintaining your desired standard of living through retirement. So these are all they all fit together. So it's very important that you write this down, and we've spoken about it before. I know I'm harping on it, your investment goals, and then put a time frame to it. Okay, so different people have different goals, over the time period at different stages of their lives. You also need to decide, do you need growth, do you need income, or you need both? When you're first starting out as a young investor, obviously you're focusing on growth assets. So we'll be touching it on just now. So growth assets obviously would include exposure to the share market, be it through a share portfolio or unit trusts and equities and things like that. Income assets, we're touching on just now. This is where you might have a unit trust portfolio having exposure to income funds or diversified income funds or money market funds. You might have a share portfolio with dividend stocks. We have spoken about it also in previous webinars. Okay. So when it comes to investing, risk is inevitable, and this is all part of the game. It's a simple relationship between risk and return exists, and the whole idea here, the higher the potential return, the higher the level of risk involved. So this is marriage. So while everybody would like to maximize the return and minimize risk, and would prefer to have a return every year of between 15 and 20% of no losses, I can tell you now that there's no investment like it. Okay, so there is risk involved, but you need to obviously be aware of those risks and take control. So, as a common rule, the bigger the potential investment return, the higher the investment risk, and the longer the investment time horizon. Okay. So your ability and willingness to accept risk will determine the suitable range of assets in your investments. Okay. So there's obviously a whole range of specific risks you have to be aware of, and there's 6 there just to highlight for you. Country risk, and we're all aware of it here in South Africa. These are domestic events, things like load shedding. We know that how's that impacting our households, but also our economy or businesses. And in our economy, we saw two years ago what happened with the July riots, especially in KZN. So this is all to do with political upheaval and financial troubles, and obviously natural disasters. We saw the floods. All these things will weaken our country's financial markets. We've got the elections next year, here in South Africa as well as the US. These things are disruptive. So that does create, as I say, a specific risk. Currency risk, we see our rand, obviously with rising interest rates, especially in the States. We've seen a lot of capital flight out of the country, out of South Africa. And obviously when they're selling rands and they're buying US dollars, that rand will, obviously our rand will fall. So currency risk is a big hassle, a big issue. And our biggest import is oil, and we have to pay that in dollars. And obviously our rand is weaker, so we have to spend more on imports. And that leads to the next point, inflation risk. And that's a big point now worldwide. Okay, inflation risk. So we can see the cost of goods, cost of food going up, and everything else is going up. That's a risk. Liquidity risk. We see this is more to do with things like call it physical property. You try and sell a property now, you can't just sell it overnight. It take a few months. So that's a challenge. So it's important to have access to some funds in near term. So have an emergency fund, have a bank account with savings for emergency funds. And the same, we have spoken about it before. Market risk. This is the risk associated with most asset classes, and we're touching on it just now. But basically, it's a risk that the investment returns will fluctuate across the market in which you're invested. Now, we talk about diversification, especially with a share portfolio. You want to spread your risk. You want to put all your money into gold stocks. You want to spread it between 3 and 5 different sectors. And, they talk about 20 different stocks. So you want to spread that risk. That's one way of managing risk in the share portfolio. That's spread, especially if you're an investment share portfolio. If you're a trader, very important that you use a thing called stop loss, or what we call contingency orders. Okay. And then we also have a shortfall risk. This is where when you wake up one day, or when it comes to retirement, and you realize, wow, my investment hasn't performed like I was expecting to, and it's a bit late to wake up by then. So, your growth in your portfolio is way below inflation. So yeah, it's important to be on track with your investments all the time. It's gone are the days of set and forget. Okay. So understand asset allocation, very, very important. This is I believe one of the key things when it comes to making growth in your portfolio is having the correct asset allocation. So it's spreading it. It's important to have some of your funds allocated to cash. That emergency fund we were talking about just now. Near-term access to funds, put some money in the bank, in a savings account, have some money maybe in a 30-day call account, but having access to cash is important. You might want to have some US dollars and things like that also. And then we talk about interest-bearing assets. This is where you start moving towards having exposure to bonds, be it government bonds or corporate bonds. But it's more higher kind of interest you're earning than getting in the banks. Money market account, interest-bearing, diversified income. This is more than unit trust. We can give you that. Then we talk about property. You can either talk about rental property, or you can talk about listed property. Listed property is very popular right now because they have higher distribution rates, call it dividend yields. Very attractive for a lot of people. And then obviously equities, and I've been harping on it at the share market. We talk about equities. We share equally in the profits and equally in the losses. But it's another word for shares. But obviously, historically, it's giving the best kind of growth. But again, the share market is not for everybody. Direct share investment, but it's important to have exposure to it, especially through your unit trust portfolio. Then I've also added the commodities. When I talk about commodities, this is more gold, silver, platinum, and oil. I'm getting a lot of queries from people that want to gain more exposure to commodities, especially gold. So yes, you can go buy the Kruger Rands and go to a call it gold coin exchange, and you can buy Kruger Rands and things like that. I think they also have silver. They also might have platinum. But from our side, from PSG Wealth side, you can gain exposure to gold and silver and platinum through what we call exchange traded funds or exchange traded notes, especially on the oil side. You can also have exposure to the rand and dollar, the dollar and euro and things like that. Also through exchange traded funds, they trade like a share. So, but remember, it's still I call it a paper asset. No, this is not a physical gold. So you might want to diversify there also. So you might have a physical property, as in the point of rental property, but you also want to have listed property. Also want to have physical gold, and maybe gold exposure to gold or silver through exchange traded notes. When it comes to commodities, by the way, they always say, and I was doing my research here, they said 5%. Nice way of diversifying. It's a nice way of reducing risk in the overall portfolio, investment portfolio. Okay, so understand the risk. So the very first thing here when it comes to risk is diversification. I think that is the most effective means of managing risk. We have spoken before, keep market movements in perspective. This is where people panic attack. So don't, if you've got a very well diversified investment portfolio across all different asset classes, be aware of what's happening in the States and what's happening with the rand and interest rates and things like that, and the impact and where the risk comes in. So it's important to review your portfolio at least annually, or biannually every 6 months. Some of you might be looking at your portfolio once a month. But the important, there's 3 ways of rebalancing. You can either reinvest the dividends. I know that some shares, especially more the call it dual-listed companies like Mondi and Anglos, they have a facility where they call DRIPs, dividend reinvestment plan. So when the dividends get paid out, you as a corporate action have the choice to reinvest back into the market and buying into that company. So big thing there is that you're investing your dividends. There's no brokerage costs. Very interesting. Top up. So you might have right in the beginning, invested at 10% of your money in the stock. Now that share as a percentage of your portfolio might have dropped to 8%. So you need to calculate what is that 2%, bring it back to, and that's what I mean by top up. Transfer, you might want to transfer, selling out of one stock, moving into others. There's ways and means of doing that too. But basically, it's just moving funds between different asset classes. You might have made a killing in the crypto market over the last few years, and you want to move some of that money into the equity market, etc. Okay, that's what I mean by transfer. Okay, it's just shifting money across your investment portfolio. So stay in the market for the long haul. There's an old saying, time in the market is better than timing the market. And in my background, I am a technical analyst, I am a trader, but I also learned as an investor, ride out the cycles. You've got a well-diversified portfolio. You have to worry about timing the market. And another thing, again, do not look at past performance. It's not a guideline for future performance. There's no guarantees in that. So very important to look at things like that. And we'll be touching on just now. It's going back to your investment objective, your goals, and your time horizon, and finding investments that will suit that, and obviously your risk appetite. But chasing the hot stocks is not the solution. Okay, so let's quickly touch on. Let me see how I'm doing with time here. Whoops. Okay, overview of value-based investing. Some of you might have heard a thing called social responsibility investments. The big question here is, do socially responsible investments outperform conventional investments or market portfolio? And they found that there's no statistical differences, in volatility or means generated from these kind of investments. So they have found strong call it co-movements. There's correlation. There's similar movements with these investments. They neither outperform or underperform. But I think the big thing here for especially the young investor that want to be more involved with value-based or ESG investing, just give them that peace of mind. They want to invest into companies that are making a positive impact or social impact. I think that is a big thing here. So just quickly, if I do a comparison, there's 5 things we're looking at: definition, objective, screening process. What other one? The other one was scope and obviously performance. So very quickly touching on this, value-based investing uses ethical or moral criteria to screen. That's an important word there. Screen investments based on principles such as religious beliefs, labor practices, human rights, and sustainability. So you could look at things like Sharia investing. We have Sharia funds available on our platform. This is call it Islam, the Islamic law. So Sharia compliant investments obviously look at things there where they want to avoid businesses that involved in the sale of alcohol, for example, AB InBev, or gambling. Also, they avoid companies that they charge interest or they make interest from other people. So obviously banking stocks. That's just an example of that kind of screening process. ESG, on the other hand, considers the environment, social, and governance factors alongside traditional financial analysis. And I'll be touching on PSG Asset Management, they view ESG investing. So the objectives when it comes to value-based investing, the primary objective there is to align the investor's values with the investments. Okay, that is the whole idea about value-based investments. Align your values with your investments. ESG investing aims to identify companies that are sustainable. Very important word there. Sustainable, responsible, and well-governed. Okay, the screening process I mentioned just now is they use a negative. They remove shares out of the universe, the share universe, and they're looking for companies based on, or they want to avoid companies that contradict investor values. ESG investing, the more of the positive screening process. They seek out companies that demonstrate ESG factors that align with the investors' attitudes. Very quickly, scope. So we're looking at the whole market. So obviously value-based investing is narrower in scope as it focuses on a specific set of values or principles. Okay, whereas ESG investors more broader, looks at a range of environmental, social, and government factors. So the big thing here is that the big push now is obviously green energy, climate change. So there's a lot of things happening in that space. Performance, as I mentioned just now, you might have a smaller investment universe as a value-based investor. So obviously that will lead to low diversification and obviously potential underperformance. That's with value-based investing, where ESG investing focuses on companies that have good sustainability practices, and that's I think is very important. Sustainability. Okay, which can lead to long-term financial performance and obviously reduces risk. So saying that, okay, what are the pros and cons of ESG investing? Because that is the main thrust now for a lot of people. We spoke, there are the two approaches share similarities, but they also differ in the objectives, the screening processes, scope, and performance. Okay, but saying that, you as an investor obviously need to decide which one matches your investment goals and values. But just quickly to summarize it, the pros and cons. Pros for ESG, it can help investors diversify their portfolio and obviously may reduce portfolio risk. That's on the pro side. And on the negative side, or the con side, ESG funds may carry higher average expense ratios. So that's number one to be aware of. But also, the ESG investing is still a fairly new concept. To be fair on these guys, it's a fairly new concept, and there isn't a ton of reporting on performance. Okay, So critics say that ESG investments obviously allocate money based on political agendas, and that's a big thing for a lot of people. Red flags there. Political agendas such as obviously a drive for climate change, and obviously focusing more rather than focusing on earnings, the best returns for savers or shareholders. They say ESG is just the latest example of the world trying to get woke. Okay, so you might have your own opinion on that too. So now let's switch over to gears quickly and talk about investment style. I think a lot of us might have heard of. It's called value investing. Number one value investor, I believe, in the world is Warren Buffett. He's a very famous value investor. He's I think, the world's fifth richest man. I think he's worth about 112 billion. I know he's recently just given some of his money away again. But value investing, basically, it's bargain hunting. We have spoken about this before. Also, bargain hunting, you want to look for shares that are trading below its intrinsic value or its fair value. I mentioned just now one of quotes from Warren Buffett: "Be greedy when everybody else is fearful." That's being a contrarian. When the market has sold these shares down, okay, the market has undervalued these shares. Those are the shares that you want to be invested in. There's quite a few shares available right now in the market like that. So we're basically looking for companies that are trading below its intrinsic value, below its fair value and price. So it's a very popular investment style that generate long-term investments, but also saying that there are a lot of shares in the market right now that have been hammered down on the market by the market. That might be what we call a value trap. You might buy them now and next week they'll be even cheaper. So just be aware of those things. Okay. So yeah, value investing often contrasts what we call growth investing. This is where you want to go for companies that are growing faster than the market average. So I firmly believe in having a portfolio that has some value stocks and some growth stocks. In your portfolio, I also believe having some stocks that are paying high dividends. That's how I like to have my portfolio. Let's talk about PSG Asset Management and their philosophy. And I think this is important for everybody to have that investment philosophy. It should be part of your investment plan. So PSG Asset Management, the way they approach the market, they have a bottom-up approach. They'll tackle a share first, and then the sector, then the industry, and then obviously move up. Whereas a bottom-down approach, you look at the whole market and then jump down to the industry, down to the sector, and then the individual stocks. But their approach, and this is what I suggest also, is to be research-driven and have that kind of investment approach in your own portfolio. So the whole idea there, they have what they call a 3M approach. The three M's refers to moat, management, and margin of safety. Basically, they're bargain hunters also. They're value investors. They're looking for companies that are trading at a big discount to its fair value. So you're looking for companies that are attractively priced based on their margin of safety, but within a rigorous call it a quality overlay, where we look at moat, which is the barriers to entry and their business model, and also the quality of management. So that's the 3M model that PSG Asset Management employs. When I was looking at their website, they do consider obviously the bigger picture. We spoke just now about sustainability, and that's very important in their whole ESG outlook. So they view ESG considerations holistically together with the 3M approach. So they look at companies that have a good ESG track record, and I know that these guys are starting to come up with numbers on with the ESG, call it factor. So it might be easier down the line. As I say, it's still a new investment process. It'll be easier to choose stocks based on the ESG number. But basically, you're looking for companies that have a clear commitment to these future improvements in time. So talking about PSG, I just want to highlight the PSG Asset Management, our multi-management offering. We have spoken about this before. We have 3 funds. This is what we call multi-manager. It's a fund of funds. We have an income fund, a cautious fund, and a growth fund. You can see on a spectrum between return and risk what these funds have been doing. You go onto our website, you'll see that you'll give a bit of a table like this, but bottom line, you can see that all 3 of them are Regulation 28 compliant. But I suggest go and click on this link here. It takes you to the quarterly commentary on these different funds. You can see how they've been performing. Okay, so just very quickly before we handle any questions, I know I've gone over time again. Sorry about that. Pros and cons outweigh the investment risk for young investors. We saw there was 4 against 3, and the 3 on the con side, I believe with financial literacy, you'll be able to bend those odds in your favor. That's number 1, and obviously the poor investment habits again, as I say, you bend those odds in your favor, and more cons getting involved, more advantages getting involved with higher risk equity portfolios as such. The reason for investing, again, as I say, is to create and preserve wealth. That's your main goal. Okay. Becoming a successful investor requires both planning and discipline. We spoke about planning. Obviously, this is your investment plan. And then obviously risk discipline. We spoke about it just now. Stick to the plan. That's where the discipline comes in. Okay, but the main thing here is that I wanted to highlight for you guys is that they are, especially we can get sidetracked with new investment processes like ESG investing and values-based investing. But bottom line, you want to invest into companies that are solid, quality companies that are growing. So you don't have to be a rocket scientist, and then slowly start with that. And then I believe that the PSG multi-managers funds can help you achieve those goals. Okay, so let me just quickly look at what kind of questions you guys might have. Cool. There's a question here from Jan. You mentioned 20 shares is a good diversified portfolio. What is a good amount of capital to start with? I always have the same questions. The more they change, the more we have the same kind of questions. So yeah, good question. So obviously, I would suggest the minimum is 25,000 because obviously the costs. You always take into consideration the costs. So our minimum cost there is 265 Rand plus VAT. So that's 25,000 Rand. Your cost is about 1%. Now with 100,000 Rand starting off with, you can buy 4 different companies. You're spreading the risk. With $1 million Rand, obviously you have more flexibility. You can go buy 20 companies at 50,000 Rand each. Yeah. I know I say 20 companies, but if I had $1 million Rand, I'd rather buy into 10 companies, put 100,000 into each one of them, more concentrated, more better quality companies. That's my way of looking at it, what I call a Peter Lynch approach to the markets. So I hope that answers your question, Jan. There's a question here from Tinswallow. I hope I pronounced that right. Tinswallow, how do I start selecting unit trusts on your platform? Also a good question. So yeah, obviously, if I can ask you some questions, is I presume you might be either starting out, investing 500 Rand a month. You might be looking at maybe investing a lump sum, or even looking at might be switching. So to use our platform, I suggest is go look at the list, go onto the website. You'll see there's a link before logging in. There's Save and Invest. You'll see our list of funds, PSG funds, multi-manager funds, and all the other funds. So obviously it depends on your goals and your time and your obviously risk. Decide what sector you want to be in. Do you want to be local stocks, low equities, medium or high equities? You want to have more asset allocation, so you might look at more balanced funds. So it depends on the sector. That also dictates your risk. And then what I suggest you choose 5 different funds that you might be interested in, and then use what we call the funds A to Z tool. This helps you to compare different funds. You can look at the performances, the fees, and the risks. And then from there, obviously narrow it down. You can look at the individual company's fund fact sheets. It gives you more of an insight into what the company's investment objectives are, their past performance, etc. So I think that'll be a process, and that's also part of your investment plan. How do you choose that? Go through that process. So I hope that helped you, Tinswallow. Okay. Doesn't look like there's any other questions. Cool. Let me just quickly summarize this here quickly. So I suggest is there's links set to those 3 multi-manager funds I was talking about, those growth funds, the cautious and the income fund. Obviously the growth is higher risk, in cautious and medium risk, and income funds is lower risk. But I also believe if you're a young investor, your retirement, having access to a retirement fund is very important. So we offer a retirement annuity. You start a little 500 Rand. And then to complement your retirement annuity, maybe consider having a tax-free investment plan. And for your emergency fund, for a young investor, I would really consider having a bank savings account, number one, so have some funds there for near term, but also having a voluntary investment plan as a great force of future growth. Okay, but hopefully this webinar recording will be available to send out hopefully by Friday, the latest, but I'll be sending it out to you guys. But from my side, guys, thank you very much for being on this webinar. There's my contact details. Send me an email at wealth@psg.co.za or contact me on that OneStream line 0860 000 368. But from my side, thank you very much for being on this webinar. Until next month, bye for now.